So Emami is the stock in focus today, and why is that so? Because Goldman Sachs is maintaining a buy on the company given a target price of 565 rupees per share for Emami, so approximately a 10 to 12% upside from the current market price. Emami as such, when you look at it in terms of overall the performance in the last 3-year revenue CAGR, it has underperformed the other FMCG companies. What Goldman Sachs is believing now that they expect Emami to start seeing a recovery coming in from the second half of FY23 after a very high base was something that was a bit of a pain coming in for the company in the pain management as well as the healthcare business, and that is behind them. So that is why we could start seeing an improvement and a recovery coming in those segments, especially for Emami Limited. Now, in terms of overall, the company has managed to sustain a double-digit revenue CAGR in terms of the Jandu business as well in Q4 and Q1 FY23, which is giving some bit of a positive sign is what Goldman Sachs is highlighting, and that is what is giving them the confidence that Emami in the medium term will could see a good outlook coming in, good growth coming in, and obviously that will be a lot of improvement coming in given the structural changes that they made in the distribution channels as well, whether you look at it in terms of greater share coming in from the modern trade or e-commerce channels. Now, other than that, in terms of margin pressures, they are highlighting, yes, maybe we could see some margin pressure coming in the near term, but we have seen commodity prices easing off, so that is one positive trigger coming in over there. So in the long term, margins will be fine. They expect them to start recovering from the second half of FY23 as well, given that the price increases that were already taken, and like I mentioned, input costs are moderating as well. Now, what Goldman Sachs is saying that they are saying that marginally they've reduced their targets, EPS targets for FY22, 23 to 25 as well, due to the slower than expected recovery that we've seen coming in the seasonal products. Other than that, they are highlighting that Emami currently is trading at a discount. It's trading at 26 times FY24 earnings, which is a 40% discount on an average of the compared to other FMCG players for FY24 PE. So on the back of that, they see a lot of headroom for growth coming in for Emami, and that is why they're maintaining a buy on Emami.